So good evening. So what we're talking about this evening relates to Chapter 16, 17, and 18. And what we are focusing on is the final stages related to completing the audit. So the audit operation, in terms of the audit operations, is the corporate earnings are considered as an extremely important indicator, which is why we're focusing on this so much. The measurement of income is generally regarded as the single most important function of accounting. Now, as we kind of go through this, keep in mind that what we're attempting to do as auditors is to focus on these estimates, and these estimates are the items that are in the control of management. And one of the significant issues related to financial reporting is the fact that an organization or a company can in fact be reporting inappropriate financial statements and yet maintain compliance with GAAP, which is amazing, but in fact that is exactly what in fact may take place. So an organization certainly has a high concern related to revenue and expenses, and they're very interested in managing these earnings from the perspective of making sure that these earnings are reported based upon what the expectations are. And if you're an executive, you're getting bonused based upon specific earning projections, and you have a vested interest in making sure that this happens. Now the problem is that there's a tremendous amount of subjectivity related to accounting reporting, financial reporting, primarily as it is associated with accounting estimates. So the accountant is concerned with a number of estimates related to depreciation, related to various components within the financial statement. So the accountant has a lot of alternatives. And what we're concerned with from the auditor's perspective is getting assurances that in fact these estimates, these management estimates that management is responsible for, are in fact appropriate. So when we're considering the objectives specifically related to our revenue and expenses, is we need to understand the inherent risk, and the inherent risk essentially is specifically related to the fact that management has a vested interest in making sure that they report earnings that are appropriate. So we need to consider internal controls. And again, when we think about internal controls, we need to think about this from the perspective that when we consider control risk and the internal controls is that we have the risk of material misstatement. Some of the management assertions that we're interested in specifically relate to occurrence. We want to establish the fact that revenue and expenses actually occurred. We want to consider this from the perspective of completeness, in the sense that everything that actually occurred was reported. Clearly, accuracy is an important issue. And then specifically related to revenue and expenses, we are going to spend a tremendous amount of time related to the audit verifying the cutoff. So when you talk about the cutoff, what we're specifically interested in is making sure that the information or the transactions that are reported for this year are transactions that actually occurred this year. And on the expense side, we want to make sure that expenses that occurred this year are the expenses that occurred this year, and that they haven't been shifted to the following year. We also want to consider revenue and expenses from a disclosure perspective. We want to make sure that the appropriate classification is there, and the presentation of earnings per share information, which becomes a part of the disclosure, is actually accurate. So what we see here is this is essentially our issue related to ticking and tying. And any time that you notice that we have the check mark here, and the check mark here is that it agrees to the prior year working papers. It also is so we have specific info. Actually, this is the check mark with the bar, and this information is decreased sales. So essentially what we're doing is we're going through the income statement and what we call ticking and tying related to the financial information. Okay, so sales, cost of goods sold, and you notice how the tick marks are. We have the upside down diamond, we have the circle with the cross with the line through it, and so forth. So each of these relate to the information on the bottom, and this essentially is how we're going to document our understanding of the process. Obviously, there's a relationship between the balance sheet and the income statement. So on the balance sheet side, we have accounts receivable. This relates clearly to sales as well as uncollectible accounts. Notes receivable and securities relates to interest dividend, uncollectible. Inventory is going to relate to purchases, cost of goods sold. Payroll from the perspective that if we are using or if we're auditing a manufacturer. Property, plant, and equipment, rent, gains, and so forth. Depreciation, and then any interest-bearing debt is we're interested in the interest. When we're considering revenue, we need to understand that there are a number of minor items as well as non-reoccurring items, as well as sort of our general flow of revenue within the organization. So the auditor should analyze the accounts to look for items that are improperly recorded as miscellaneous. Collections on previous written off accounts. We should consider the write-offs of old outstanding checks or unclaimed wages. Proceeds from sales of scrap. Rebates or refunds from insurance premiums, as well as proceeds from sales and plant and equipment. We are considering any adjusting entries. We're definitely going to be performing analytical procedures to investigate any unusual fluctuations, and we want to determine if there are material amounts specifically related to unrecorded revenue and significant misclassification affecting revenue. Now, an example that I can give you is when I was conducting an audit of one of the organizations that I was associated with, is the organization was actually reporting as other revenue rebates that they were receiving from manufacturers based upon the purchase of specific sales volumes. Now, what we determined based upon consulting with the auditor was in fact that these items should not be reported as other revenue, but in fact should have been reported as a decrease in our cost of goods, okay, or cost of supplies. So in this case, we didn't have cost of goods sold, but we had supply expense. So the idea is that what we were doing, and then again, it didn't have anything specifically related to a change in net income, or in our case, a net loss, but what it did is it shifted revenue to a decrease in our supply expense. Okay. Another example of ticking and tying. So you notice here that we have very specific tick marks, and these specific tick marks are related to specific comments as we are going through this. Now keep in mind that each organization is going to have their own specific tick marks, so you don't necessarily have to understand tick marks and think that they're global. every organization is going to have their own. And what we're really focusing on is the fact that the tick marks then create a documentation and a link to the supporting documentation specifically related to this. Okay, so when we're talking about administrative expenses, so we're talking about the expense side of the income statement, is what we want to consider is how do we actually test this? Well, part of our substantive testing can and should include some of the analytical procedures that we're considering here. And again, whenever you talk about analytical procedures, we need to understand that analytical procedures are these procedures that are essentially are metric based. These analytical procedures are required as part of our planning stage and as part of the ending process within the financial statement audit, but they also can be used very effectively as our substantive testing. And again, whenever you see the word substantive testing, in substantive testing we are measuring monetary misstatements. So the audit results in terms of the fair presentation of the financial statements is based upon our substantive procedures. So we're looking for exceptions. And one of the things that we want to consider as we are looking at the analytics for the income statement, the expenses and revenue, is considering this in conjunction with the budget. So budgeted results, and in fact the variances to budget, can in fact be the starting point of some of our analytics. So what we're considering is the differences. We're also considering differences specifically related to industry standards and prior year amounts. We want to compare the account balances with the expected account balance. And again, where's the expected account balance going to be? Well, if you consider the ratios that we've had in prior years, we in fact can have a target for an account balance, and if that the account balance is within range, then we're going to be fine. If it's not within the tolerable difference, we're going to investigate any differences. One of the things that can keep in mind is that when we're doing analytical procedures if there is a difference, it doesn't necessarily mean that that difference is wrong. It just means that we are going to investigate it. Okay, so when we're considering additional substantive testing specifically related to selling, general, and administrative, we want to obtain or prepare an analysis of selected expense accounts, examine accounts based upon the results of analytical procedures. Some of these accounts include advertising, research and development, legal expenses and other professional fees, maintenance and repairs, rents, and royalties. Now, so why are we sort of considering analytical procedures specifically related to these? Well, we're clearly going to do some testing, as an example, related to advertising or research and development. There's no question about that. But as a baseline, as an example, if research and development has consistently been 10% of sales, which is typical for a pharmaceutical company, maybe less, maybe more, depending upon the type of organization. But if it's consistently 10% over the past few years, and it remains at 10%, then we're pretty much certain that we're within range. We're going to be doing some testing, but considering that as a percentage of sales, if that hasn't changed, we know we're pretty much on target. I'm a treasurer for the cooperative that I own here, and I live here in Manhattan. And we spend a lot of time specifically related to budgeting. And one of the things that becomes very interesting is as we are going through budgets from one year to the next, is the expenses tend to be very, very consistent with a few exceptions. And these expenses are consistent with a sort of an upgrade based upon inflation, 2 or 1% or whatever it is. So as I'm looking at the financial results, I'm comparing this to budget, I'm comparing it to prior years, and I'm looking for variances that go beyond a tight tolerance level. And once I see those items that are beyond the tight tolerance level, I'm going to investigate those. Doesn't mean they're right or they're wrong. It just means that it is pointing me in the direction of where I want to go. Okay, so we're going to obtain or prepare analysis of critical expenses on in the income tax return. So the income tax return is absolutely not going to relate item for item related to the income statement, but it absolutely provides a framework for comparison as we are considering these amounts. Payroll, typically the largest operating expense. Payroll fraud has been common and often substantial. What we're concerned with is extensive segregation of duties, use of computers with proper controls, filing of frequent payroll reports to the government. Okay, so we've talked about payroll in the past. What we're concerned with is understanding some of the things specifically related to this as we are comparing or as we're auditing the income statement. So from a control perspective, we want to understand that the employment process of human resources is separated from timekeeping. Okay, so timekeeping, separate component from personnel. So the timekeepers are adding time, but they're not going to be able to change any employment information, even addresses, clearly not pay rates or anything like this. We need to understand the controls specifically related to the payroll preparation and record keeping. Generally speaking, what's taking place is at the department level is there is a timekeeper. The timekeeper essentially is validating this time. The timekeeper then gets this approved by the director or the department head, and then that data file then goes to the timekeeping department. Doesn't go to personnel, doesn't go to human resources, but it goes to timekeeping. So again, you notice that we have very specific segregation of duties related to this process. So when we're considering the employees, most employees now are going to get direct deposit. So in the past, one of the audit tests that we, generally speaking, did was the auditor would actually be a part of the check distribution. Well, the problem with in the current economy or the current situation is, and you're probably exactly the same, is that if I have I get a check, I get paid every 2 weeks, but I don't really pay attention to that check, that physical check. I may not be around when the check comes through. Doesn't matter. What matters is that that money then gets deposited into my bank account. So doing a payroll distribution from a control perspective is somewhat meaningless because 95% of checks actually get direct deposited. So as we are considering this direct deposit, is we need to understand what are the controls specifically related to this. And now you notice the term an impress basis is when we talk about an impress account, essentially what we're talking about is there is a separate bank account for payroll. So we're separating the payroll account from all the other expenses. We want to do this from a couple of different perspectives. It has a control perspective. We also have the ability to clearly monitor this, because as we are issuing the payroll every 2 weeks, is we're doing certain analytics before the payroll actually goes forward. The other thing is we want to make sure that there's clearly enough money in the account to make our payroll run. Okay, so these are the kinds of controls that we're considering related to payroll. So when we're considering tests of controls related to payroll transactions, is some of the things that we're considering is names and salary rates to what is maintained by human resources. Now, if you look at A, one of the problems that most organizations have, and at least the organizations that I've dealt with, is it's pretty easy in terms of relating salary rates to what this person is making, except when this person has been around for 20 or 30 years, or even more than that. Because the problem there is you don't really have a good documentation of these salaries, the incremental increases in the salaries that have taken place over the years, because most of that stuff was actually took place in a pre-IT environment. Okay, so that's one of the problems specifically related to this. My issue related to this is, well, does it really matter if this person is getting paid within reason as compared to other people within the department with the same skill set and so forth? But that's one of the things that you need to kind of consider as we are going through this process. Okay, so when we're looking at substantive procedures related to payroll, clearly looking at analytical procedures is important. What we're considering also is fluctuations in salaries and wages. We want to obtain a summary of amounts of officer compensation. Clearly, the risk areas are going to be officer compensation as well as the sales personnel, making sure that they're actually receiving the appropriate bonuses based upon actual performance. We're going to be doing some period-ending testing related to payroll, as well as doing some computations specifically related to accuracy. Okay, so we talked a little bit about Chapter 16. Let's now move to, see if I can find this here, is Chapter 17. And Chapter 17 is specifically related to the audit reports. Okay, so let's talk about the audit reports and how they relate to everything that we're doing. Okay, so the audit report essentially is our expression of our opinion on the fair presentation of the financial statements. When performing the audit, the auditor obtains reasonable assurance, and in fact, that's exactly what we say in the text of the audit report, is that we are providing reasonable assurance about whether or not the financial statements are free of material misstatement. Keep in mind that the audit report explicitly states the financial statements that we're looking at, including the balance sheet, income statement, statement of cash flow, and statement of retained earnings. The notes of the financial statements are considered integral to the financial statements. You notice I think we've presented a few audit reports over this semester, but the title includes the word independent. Now, it's normally addressed to the company, shareholders, or the audit committee, or the board of directors. And the reason this is important is that we are not reporting to management. We as auditors are reporting outside of management to the principals of the organization through the board of directors, audit committee, or in fact the shareholders of the organization. You notice that the audit report is signed by a CPA, which is kind of interesting. The idea is that the reason that we get a CPA license, the functional reason that we get a CPA license, is that we're able to sign a audit opinion letter. Okay, so there's certainly intrinsic value related to our CPA license beyond that, but the idea is that the only person that can actually sign an audit opinion letter is a CPA. Now you notice that it's dated as of the date which the auditors obtain sufficient and appropriate evidence. So one of the things that becomes very interesting specifically related to this is the fact that there is a process. So the process is that we are engaged in the audit. At a certain point in time, we leave the organization. So we leave the organization because we have obtained appropriate, proper evidence, but there's a gap in time between that date and the date when the financial statements along with the audit report are issued. So that gap in time essentially is this time period that we need to be concerned with, specifically related to what might be happening within this time period. So the standards, and what we're looking at here is these are the AICPA standards. The AICPA standards are different as compared to the PCAOB standards. But in this case, the AICPA standards start with that we've audited the financial statements and the related consolidated statements of income, retained earnings, cash flow for the periods then ended. The audit report explicitly states what management is responsible for. Management is responsible for the preparation and fair presentation of these consolidated financial statements in accordance with U.S. GAAP. And they are presenting these financial statements with the idea that they are free of material misstatement. Now, what is the auditor's responsibility? Well, the auditor's responsibility is in the next paragraph. Our responsibility is to express an opinion of these financial statements based upon our audit. You notice that we conduct the audit in accordance with the auditing standards generally accepted in the United States. So again, this is the AICPA. So we are going with the audit standards from the AICPA as opposed to the PCAOB standards. Okay, so what do these standards require? They require that we perform audit procedures to obtain evidence about the amounts and disclosures. The procedures depend upon auditor's judgment including the assessment of the risk of material misstatement. And essentially what we're driving at here is this assessment of the inherent and the control risk determines the substantive procedures, and it's through these substantive procedures that we are essentially evaluating the overall presentation. In an unqualified, or what we're calling an unmodified opinion, from the AICPA perspective, is what we're saying is that the financial statements present fairly the financial position of the organization. And that's really what the goal is specifically related to this. Okay, so conditions required for the issuance of an unmodified or an unqualified opinion is that we're able to obtain appropriate evidence, and what we want to also consider is the difference between the standard report from the AICPA perspective as compared to these public companies. Okay, So the difference is that we use the word registered and independent in the title. We reference the standards of the PCAOB rather than our generally accepted auditing standards. We include less detail related to each of the individual's responsibility of management and the auditor. And there is an additional paragraph that also talks about the internal controls over the financial reporting. So we're going to use the verbiage here is the report on the internal controls may either be presented as a separate or in combination with the financial statements. And then we're not using headings. So let's talk about the various opinions that are coming from the audit report. So you notice that the first two is unmodified and unmodified with the emphasis of a matter. Now, if this is a PCAOB audit, we're going to use the term unqualified. But the idea here is that an unmodified opinion is an opinion that is issued without modification. So this is what we call a clean opinion, and essentially this implies that the financial statements are free of material misstatement. But in any event, we may in fact include a paragraph with the emphasis of a matter, and we'll talk about these in a few minutes. An unmodified opinion with other matters to emphasize matter, and an unmodified opinion on a group of financial statements. And in this case, what we're talking about is if in fact we are completing the audit in conjunction with the activities of someone else. Now, how does this relate to an audit where in fact there are issues? So if there are issues, the first thing is if the issues specifically relate to a specific subject matter. In this case, what we're doing is we are issuing a qualified opinion. So the qualified opinion basically is saying is the financial statements present fairly the financial position of the organization, but we use the term except for, and then we define what this except for is. And an adverse opinion is, it states that the financial statements are not presented fairly. In the disclaimer of opinion, we're stating that we are unable to form our opinion. Maybe we're unable to form our opinion because we're not independent, or because we're not able to get substantial evidence related to the financial position of the company. Whenever we present the financial statement information, is we are concerned with, is this what we call a going concern? In other words, is this organization going to continue beyond this year? So we're not required to perform specific procedures related to going concern, but the idea is that we have the specific assumptions related to a going concern. So what we're saying here is that if in fact we audit the financial statements and we determine, yeah, the financial statements are or they're not fairly presented, but that's beside the point. The point is that this organization is in fact not doing very well, and we are concerned with their financial viability. And if in fact we don't believe that the organization is going to sustain itself beyond the current year, then we need to issue what we call a going concern paragraph related to the financial statements. So this is a paragraph related to a going concern. And again, this is a emphasis of a matter, is the financial statements have been prepared in accordance with, or with the assuming that the company will continue as a going concern. As discussed in Note 1 to the consolidated financial statements. The company has suffered negative cash flow from operations, and it explains the problems. Management's plans in this regard are also described in Notes 1. The consolidated financial statements do not include any adjustments that might result from the outcome of uncertainty. Our opinion is not modified with respect to this matter. So basically what we're saying is that we can, in fact, issue an unqualified opinion, but we would be including a paragraph specifically related to going concern. Because basically what we're saying is the presentation of the financial statements is fairly presented. However, as you're looking at these financial statements, be aware that this organization is suffering significant financial issues and in fact may not be able to continue beyond the upcoming year. And that's really what we're talking about in terms of the going concern. This is another emphasis of a matter, and you notice here it says, as noted in Note 5 of the financial statements, the company adopted the Statement of Financial Standards update, in our opinion, is not modified with respects of the matter. So the idea here is that we have, or management has changed their reporting from one GAAP system to another. Nothing wrong with that, but the issue becomes consistency. Additional emphasis of a matter include risk of uncertainty, significant related party transactions, the company is a component of a larger organization, unusual significant events, accounting matters that affect comparability. So we've talked about this in the past. Is an integrated audit is where the auditor is expressing an opinion of both the fair presentation of the financial statements as well as the audit or the expressing an opinion of the auditing or the audit controls related to the financial reporting. Okay, so we're expressing an opinion on the controls over financial reporting. This is a requirement of Sarbanes-Oxley. 404A requires the annual report filed with the SEC to include management's acknowledgement for the establishment and maintaining of adequate internal controls. Provides the assessment of internal control effectiveness as of the end of the fiscal year. Now, make sure that we understand this is when we are issuing an opinion specifically related to the internal controls, we're not issuing the opinion based upon the totality of what was taking place throughout the year, is we are expressing our opinion based upon what took place as of the end of the year. Okay? So what else is required? So in 404B is the CPA needs to audit the internal controls and express an opinion. This is required for companies with a capitalization in excess of $75 million. Management responsibility is to acknowledge the responsibility for the effectiveness of controls, to evaluate the effectiveness, to support the effectiveness with sufficient evidence, and to provide a report. So basically what we're talking about here is that management is specifically required to conduct control testing related to the controls over financial reporting. And that then becomes the basis of their presentation at the financial statement level related to internal controls. So this report must state that it's management's responsibility. It identifies the framework for evaluating internal controls. Generally speaking, this framework is the COSO model of the internal control framework, and it includes a management assessment of the effectiveness of these internal controls as of the end of the most recent fiscal year. And again, what this is saying is that if we identify a weakness at the beginning of the year, we correct it during the year and are able to do enough testing to validate the fact that the control is working appropriately, then we can essentially say that as of the end of the year is that we don't have a control weakness. Management can be assisted by consultants, but not by the CPA firm that conducts the audit. So basically what we're saying here is that the audit of internal controls can be done by external parties. And in fact, there's a lot of organizations that actually thrive based upon doing this control testing over financial reporting. It can also be done by the internal audit department, or you can develop your own controls department within the finance department. But in any event, the takeaway is that the people that do the control testing cannot be the same organization that does the audit. So management needs to understand the definition of internal controls, and again, we're primarily talking about this COSO framework, and we must understand the concept of internal control deficiencies, significant deficiencies, and material misstatements. Why is this important? Well, in a reporting perspective, the only time that we are reporting in this external report is when there are material misstatements. So if there's significant deficiencies or just control deficiencies, we're not reporting to the outside world. It's only when we have a material weakness. Now keep in mind that we're talking about internal controls. So from an internal control perspective, we are not considering whether or not these weaknesses in fact created material misstatements. So in fact, theoretically, you could have a material weakness in internal controls, but in fact not have any material misstatements in the financial statements. Okay, so this essentially is the diagram, and again, what we're looking at is the material misstatements. So control deficiencies essentially is where the control does not allow management of the employees in the normal course of business to prevent misstatements. In a evaluation is what we're looking for related to what the auditor is doing is the auditor is evaluating the internal control testing that management is doing. So what we're considering is the reasonable basis for the assessment. We are evaluating design effectiveness of controls, evaluating the operating effectiveness of these controls, documenting the process, and reporting. So in fact, the auditor must in fact issue an opinion. And again, the auditor is issuing an opinion based upon the objectives of management in regards to what they're doing related to internal control testing. I think we are on track in terms of getting this session done. We are going to have our next session in a couple of weeks, I think 2 weeks, and then we have a sort of a quick turnaround in terms of getting to the end of the semester. So everyone have a great evening and have a wonderful Thanksgiving.